Hello and welcome everyone to our live event today. The topic is Decoding Division 296 Super Tax, planning ahead for your clients and for advisors. All right, introducing our instructor today. He is the director of DBA Lawyers and is one of Australia's most respected leading lawyers in superannuation and SMSFs. So please put your emoji hands together to give a very, very warm welcome to Daniel Butler. Hi, Daniel.
Oh,
How's it going? Oh, I think I can't hear you there.
hi, Joyce.
Yep, I can hear you now.
Yep,
Amazing.
technology.
Welcome to our platform. First time event for you. So good to have you with us. Super excited about this topic.
Well, thank you. And it's really good to be here today. What a riveting, what a great topic. The unrealized gains tax.
Yes,
So
very controversial as well.
very controversial. So look, this is the agenda that I have. We're going to step through developments. We'll look at some calculations. We'll work out on some case studies. So we're a law firm. I'm a chartered accountant myself, but I don't practice as an accountant. But we've ran some numbers. We've done some spreadsheeting, because it's very important in this area when you have clients who are affected or who might be affected, that you have good numbers to support your analysis. We'll look at some structuring, because some people are saying, hey, I don't like this tax. I'm going to pull my money outside of super and I'll deal with my money outside of super, assuming you can do that. We'll look at some succession and other aspects as well. And I have a surprise for you at the end of this topic. So I don't want you leaving early. We've got this special guest surprise feature at the end of my session. So once I finish, I'll introduce you to my special guest at the end and keep you in suspense until then.
Amazing.
So let's move forward. What is this all about? Now, before we get into it, I'll just do a little bit of background, because this is not yet law. We're talking about a hypothetical at this stage. A lot of talk. Yes, it's been hanging around for the last 2 years like a bad smell, if you don't mind me saying. But we will have both houses of parliament sitting soon, and it hasn't yet, to my knowledge, been introduced into parliament. It's likely to be a top priority for the government. The Greens are still agitating for 2 mil plus indexing. And therefore, today, I'm going to talk on the assumption that this is law. It is law from 1 July 2025, and that there's no changes to what we have seen in the bill. Now, there are assumptions which may change. Hopefully, they will change. But one thing we can say, there's been widespread adverse publicity. The adverse publicity largely centres on the unrealised gains tax. It's not being indexed. And another little issue that I have, well, it's a big issue, why tax people on blue sky, but if they make a loss, why not give them a refund or a deduction against other income? So the Tax Institute's really been driving these 3 points home. So the publicity hasn't been complaining about, hey, government, we're prepared to pay the tax. It's all about, don't bring in this unrealised gains tax, because this is really out of sync with everything we've known. Like capital gains tax 40 years ago, yes, that's on realised gains. And the thing about realised gains, you may actually have some money to pay the tax because you've realised the gain. So I'm not going to go through all of this introductory part on the criticisms about this, but here's the Tax Institute. It introduces a principle that says you're going to be taxed on money you don't have, and even more astonishingly, may never have. The SMSF Association has also been very critical, and the SMSF Association has said, Treasurer Chalmers, who says oh, we've had it out there for 2 years, no one's come up with a better concept. Well, they have said that's farcical because we've been trying to work with you, because self-managed funds can easily report on a taxable income basis. So it's not a problem for small funds. It's more the large funds which the government is seeking to appease here. Here's another good paper, and you can download this paper separately. This is by Wilson Asset Management. You might remember Jeff Wilson really undermined Bill Shorten's go at an early election on franking credits. So Jeff Wilson really undermined Shorten's election back then because he really got to pensioners, etc., who would have missed out on franking credits. Well, here's another report which is really aimed at looking at this tax from the point of view of how it's going to hit so many people. Like, their calculations are, if the Greens are successful at reducing the 3 mil to 2 mil, 1.8 million members will be immediately covered. And that includes 780,000 of members under 30. So if the Greens get their way, we've got an immediate 1.8. It's no longer this 0.5% of the super population, this 80,000 cohort. It's 1.8 if the Greens get their way. And who knows, will the government come out and say, okay, we've arrived at 2.5 because we had to do a deal with the Greens? We don't know. It's a frustrating thing about our legal system these days, politics. It's the politics that really gets bad law. And the government really hasn't taken on a lot of feedback out of the consultation process. I was involved in the consultation process myself, and we had very little input and a very short time to provide that input. But even this Wilson Asset Management report also predicts that there's going to be 8.1 million people in 2053 who are going to be covered by this. So, and that's people on an average balance today. So if you're about 30 today, in 2053, you'll be hit up with this new tax. So it's really one of these taxes. When you go back to 2017, the government said similar things to the restriction to pensions, the $1.6 million pension limit, and contribution limit on the total super balance. The government said there's only 1% covered, but you look at it today, there's many times that are covered, and we assume this will be a similar outcome. Wilsons have also come up with this figure of a $94.5 billion hit to economic efficiency. They're saying this is a dead loss. So there's a lot of economic theory here. Read this report. The University of Adelaide did very thorough reports as well, and that's their figures on who's going to get, how many are going to be hit, and what amount they will be hit, and the number of funds that would be covered. So they did come up with about average between 80 to 90,000 of tax on average, the average hit on those 80 odd thousand members. They also concluded that it would be somewhat top heavy. That is, in 320 funds, it would be raking in about 28% of the revenue. And in a different year, it was just shy of 300 funds would be pulling in almost 60% of the revenue. So some of the large funds will really pull in the revenue for the government. And that's what really brought this on. It was about 30 funds, about 30 self-managed funds that had more than 100 million in them. And people are saying, hey, that's outrageous, having more than 100 million in the fund. And that's true. People did not disagree with that. But when we were talking about that years ago, it was like, okay, maybe they'll get to people with more than 10 mil. And then we thought, no, it's more likely to be more like 5 mil. And when the legislation finally came out, it came down to 3 mil. So you see how the numbers just rolled out. So the University of Adelaide said, look, there's going to be members who won't be able to pay this tax. It's also going to be bad for farmers and those with illiquid assets. It's going to increase the rate of liquidity problems by a multiple of 4. It's got far broader consequences than what government has actually predicted.
Yeah, I think the whole startup community is really against it, given, the nature of startup. And I imagine yeah, gone are the days of holding any crypto in SMSFs, if this comes in, right?
Yeah, and that's it. It's going to change strategic decisions from an investment perspective, because people will say, I don't want to put in investments that's going to go well into super. So it also then dries up a lot of the investment capital. And that's one of the things that Wilson Asset Management said. They said, look, these potential investors are no longer going to be there. It's going to be outside of this because of Div 296. People don't like paying tax on blue sky, particularly if you lose. Bad luck, you're on your own. Very unfair. It's very not symmetrical. My analysis would be, if you're going to tax blue sky, give them a loss or give them a deduction against other income or give them a refund, So that's fairness, but this is totally unfair.
Yep.
And if you've got volatility up and down, that's where you really get hit. We'll go up one year, down the next. It's just going to be up and down like a yo-yo for some people. You look at the markets, and if we have a market correction, watch out, because you might be suffering a loss. You've paid the tax on the way up and you get this big loss. Bad luck, you may never recover. You can carry forward that loss, but it's a quarantined loss against a future upside of your super.
Very limited.
Yep. Illiquid assets, really bad. Farmers are really complaining. Those with property complaining. Some people have no income generating assets, and therefore they're going to get hit up with this extra tax, but no extra funding to do it. So it means they'll have to offload potentially good investments to pay the tax. And University of Adelaide concluded, well, if the government wasn't so greedy, if the government went to taxable income, they would be better off, and everyone would be better off, including the economy, and they wouldn't get that hit that Wilson Asset Management said of 94.5 billion dead loss hit. So, the government's been very obstinate. They haven't been taking it on board, much of this criticism. And Chalmers says, and Albo says, it's only a small 0.5%. They can afford it. It's not a problem at all. And it's only moderate changes. Well, that is not really playing ball.
Yep.
We really hope the government does get backlash from this, because I don't think it's a way to consult and run the system.
Yep.
And as I said, no one's complaining about we'll pay the tax, just fine tune it. So anyway, I'm not here to complain. I'm here to be positive today.
But we can't help it. So how does it actually work?
Well, exactly. But before we go there, we've got people coming to us, we're going to get hit up with this extra tax. It's going to be 30% on our super. So, Joyce and I were talking about this. This is pretty numbers rich here. We've done some calculations. Not a lot of lawyers go and do spreadsheeting, etc., but we've done that for you today to save.
I hate it when I read headlines in the news. 30% tax in super now. I'm like, that's not right. Like, you can't say that. Anyway.
Yeah. So where I'm going now, I'm saying, well, what are you really paying in super? That's what we need to do first. We've got to work out, what are we paying inside and what will we get hit up outside? So if we go through it, while it's typically 15% on capital gains, if we get the 1/3 discount, it's 10%. And if we've got the pension, it's nil. So a super fund is a very special taxpayer. We've got 3 tax rates. In fact, we've got another tax rate that's 45%. That's if you've got non-arm's length income. But we're going to keep NALI off the topic today. That's for another day. We obviously have to consider transaction costs. So if your client says, I don't like this tax, I'm going to pull my money out of super, there's generally transaction costs we have to calculate. And you've got to be very careful about that. And we've got a case study on that. So I've just given you a worked example. We've got some ordinary income, we've got some taxable contributions, we've got a capital gain, we've taken the 1/3 discount, we've held the asset for more than 12 months. We've got some pension exemption of 30% at play, got some deductions. We've got some non-deductible deductions, because when we run a pension, not everything is 100% for gaining assessable income. So we've got to knock out our non-deductible deductions. And we end up with a effective tax rate in that fund of 9.6%. So if you say to your clients you're paying 15% tax, well, it's not necessarily correct. So I just wanted to, put that to you to analyse the numbers to see what the average rate of tax is. The other thing is that I haven't taken into account here, which you may want to take into account, franking credits. You get a refund of your franking credits. That's another element. How do you treat your franking credits for the analysis of modelling to see if your client is better off ripping money out or keeping it in super? Here's the calculation. My take on this calculation is I've been having debates. Is it complex? Is it simple? Some people have been saying it's simple. I think it's complex. It's very complex because you'll see why in a moment. But remember, John Hewson got unstuck trying to introduce GST because he could not answer the question, how does GST apply to a birthday cake? So he could not even explain to the media how GST applied to a birthday cake. Now, I'd really like to see Albo or Chalmers explain how this tax works because I've got 40 years experience in this industry and I struggle and it's complex and there's a lot of ins and outs, there's a lot of complexity. And the other thing is I don't think any of the super funds would be investing any money in changing their systems until this is a real deal, until we see the law. And as I said before, we don't know what the law is, we don't know what form it will be, and we don't even know when it will start because digital service providers and large funds need at least 12 months notice to get their systems in gear and tested so it's operational. And there's a lot of these sorts of issues with the tax office. They're doing it manually. They're doing it manually because they haven't got the systems in place. So you see, it's a real mess when you got politicians trying to drive this stuff with no idea of what's happening at the back end.
Completely agree.
But you elected them. You're to blame.
Oh well.
But this is the formula. And, it's 15% tax. That's the maximum tax. You look at the TSB at the end, take off the 3 mil because you have to be over 3 mil to cop this tax.
Yeah. So TSB is a total super balance?
Correct. Total super balance. And then you look at the TSB at the end, and this gives you a percentage or a proportion of the tax. And we give an example in a moment. And then we get into super earnings. And super earnings is your total super balance as adjusted by heaps of things we'll talk about. Mm-hmm. That's where it gets complex, minus your prior TSB. So that's the formula. That's what we're going to work through. But I don't think it's simple. I think this is complex.
Oh, it's the worst.
It's going to run up a lot of complexity. And if you have a problem, let's say there's one error in the system, that's going to cause a lot of issue to get fixed. Mm-hmm. And there's multiple ways where you can get hit with issues, with system issues. So what we're just unpacking here is total super earnings. And there's a critical point here that I mentioned in the first bullet point. In order to get hit with this tax, your total super balance at the end of 30 June 2026 must be greater than 3 mil, and you have some super earnings greater than nil. So in order to get hit from 30 June 26, you need to be over 3 mil. So if you pull your money out before 30 June 26, you won't get hit. Mm-hmm. Each subsequent 30 June, we've got a similar system at play. This is the provision, 296.35. So you need to be over 3 mil before you get hit. And there's an article on our website that drills down on that point. We then make adjustments to the TSB. As I said, if you go back to that formula, there's this concept of adjusted TSB in calculating your superannuation earnings. And that is the TSB at the end plus benefits being paid. So if you've made any withdrawal from the system, you add it back. They even tax you on a withdrawal to pay the tax. So even if you're not retired, you can pull out money to pay Division 296 tax or any other tax to super, pretty much, where you get a release authority on, like Division 293 tax or excess contributions tax. Mm-hmm. They give a release authority, and when you get a release authority, you can pull it out of the system because the government doesn't want to be having unpaid tax. But it's a bit rude that you get taxed on what you have to pay tax on. So it's a tax on a tax. This is actually a tax on a tax on a tax.
Yeah.
Because you're getting taxed inside on a realised gain, and then you're getting taxed outside on an unrealised gain, which includes the realised gain.
That's just crazy. Yep.
And it does encourage you to adopt tax effect accounting. So tax effect accounting is where you're putting a provision in for future tax liabilities.
Mm-hmm.
So you've got to add all these things back, and I don't have time to go through all of these today. And then you've got to start subtracting things. So anything you pull out of super, add back. Anything you contribute to super, you got to then deduct. So you see, but this is a very simplified basis of what you've got to deduct. It goes on and on and on. It's very complex. And you just imagine the errors that can come into the system through this whole array of things. I think Treasury, I don't know what Treasury were on when they actually drafted this legislation. It was just crazy. And we were trying to sit down and say, well, is it fair if say husband splits from wife and he splits half of his super, he's to add that back and the wife has to take it off her balance. So it's got all these things. But the other thing is on death, it does have some aspects on death where dad dies and mum takes the reversionary pension. Mum has to add back the pension payments, but she can deduct the capital sum of the account balance from dad's pension. So there is some adjustment there in that first year of the year of death, just so it doesn't add another death tax to the system.
Okay. All I heard is, it's very complicated then. and complex situations do arise, like death and spouses.
Well,
Okay.
it is so complex that advisors will have to get their heads around this stuff. They'll have to do a lot of modelling, getting the modelling right, getting the numbers right. Just have a conversation with client, and the clients are going to go, "Jesus, this is complex."
Yeah.
And you can tell them that this is all government-inspired complexity.
Okay.
Because get this, it's only supposed to affect 0.5% of the super population. However, everyone pays for it.
Yeah.
So you've got these funds with millions of members. Some of the largest funds have 7 million members, but they're going to pay for all their systems. And I've been hearing from committees that I'm on that the costs for updating the software are huge costs. So every member, including members who may never be affected, are paying for systems and upgrades to systems by funds which they may never get hit by. So that's the stupidity of it. It's just the government doesn't have to pay the collection costs. The collection costs are thrust on to industry who have to pay for these systems. Anyway, again, I'm going to be positive today. I'm not here to be a naysayer.
Oh, good.
As I said, I'm prepared to pay my tax, but not on unrealised gains so much. I'll pay it under sufferance, but I don't like the principle. The Tax Institute, many professional bodies don't like the principle. You pay on blue sky, but you don't get a deduction or a refund for loss.
Yeah. Particularly if you have to pull funds out to liquidate, or to pay the tax, you get taxed on that as well.
Well, you think of farmers. Farmers are going through hard times. Droughts, floods, other issues. Land isn't readily divisable. To come up to pay this tax, they will have to liquidate, and it's going to be a lot of restructuring for a lot of people, as you said, in the venture capital industry and so on.
All right, moving along. We're almost at the halfway mark.
Yeah, well, that's good. I hope people are enjoying it out there.
Let us know what you think. Got some opinions on the chat, which is interesting to see.
I see a few thumbs up, a few hands, love hearts. I love that.
Yay.
This one is the percentage. We're now looking at the formula, the percentage. The percentage is very important because I said before, people say it's a 15% tax. Well, I've already looked at inside the super fund, and inside the super fund it was less than 10% for that example without franking credits. But now I'm looking at the percentage of Div 296 tax that you pay. And the Div 296 tax that you pay is not 15%, it's based on this percentage. So working that percentage, I put some numbers together and I've shown you here on 5 mil. Based on 5 mil, we're 40% of the proportion. Therefore, we're paying an effective rate of 6%. Gear it up to 6 mil, it's 7.5. 7 mil, 8.6, 10 mil, over 10%. And if I was one of those lucky ones that had 100 mil, I'm paying 14.6. So you've got to be up over 100 mil before you're actually paying the 15%. So if you tell your client it's 15%, that is not accurate. However, as we said, widespread media publicity is it's an extra 15%.
Yeah. They don't understand the concept of effective tax rate versus nominal, I think.
Correct. Now, here's an example. Here's Jarrad. Jarrad's got 6 mil. So as mentioned, the formula is 6 mil minus 3 mil divided by 6 mil at the end is 50%. So Jarrad's effective rate is 7.5%. And here's Jarrad. Jarrad with these numbers, he's had an increase of $500,000 on, say, share portfolio, and he's made a withdrawal of $150,000 on, say, his pension. He's got $650,000. So $650,000 by 50% by 15% is about $50,000. So he's got to come up with $50,000. You know, it's $50,000 he has to come up with on those numbers.
And, you know, what if it's just shares? Then he could potentially sell and pay the tax, right? But if it's land, where's the cash going to come from?
Well, Jarrad might have to go back to employment. He might have to get a job.
Yeah, that's the problem, isn't it? Just the liquidity of the asset. Yeah, it just depends on what the asset is.
Well, okay. You know, we have a lot of clients, and in Victoria, like, you've got no idea about clients with land tax. Their land tax, for them to hold the land, the rent doesn't even pay the land tax down here for a lot of properties. If they're a valuable property, I've got clients, they're underwater just paying land tax, let alone the rates, let alone the expenses. So
this will have huge repercussions to the property industry. Like
it is. Yeah. Some people say buying property in Victoria is cheap now, but it's all the taxes.
Yep.
Might be cheap to interstate, but we've got the highest taxes in Australia. It's not a place that's to invest for property. No, I don't give investment advice, by the way, but a lot of our clients are very, very irate about what's happening in Victoria. As I said, we've done some numbers, and here's an example. Someone who's looking at, look, I've got an investment decision to make. Shall I keep $5 million in super, or shall I pull it out, invest it outside of super? And this is just to give you a feel. Let's say the income is 3% per annum, the capital appreciation is 7%. And we're looking over a 10-year stretch to get an idea as to, well, when we wind up in 10 years, where do we stand?
Particularly, you mentioned that the date that we check the threshold is 30 June, right? So assuming if it starts 1 July 25, we got till 30 June 26 to plan something.
Yeah. And if people want to withdraw up to 30 June 26, they can do that. So here's John. He's got $5 million. He acquires an asset. The asset will increase by 7%, 3% income. So that asset is almost doubled over that 10-year stretch. As you can see the numbers there. I'm a lawyer. Please check my numbers. If we look at scenario one, if he buys and then sold outside a super fund, he's on the top rate. So this assumes he's already used up his marginal rate. 1A, he's got his marginal rate, so he's going to do it outside of super. Scenario 2, he's going to do it inside the super fund, but it's in accumulation mode. And scenario 3, he's going to do it inside super, but he's got the maximum pension of, I've got 1.9, but this was done before 1 July. But today, if you haven't started the pension before, you've got a $2 million transfer balance cap. So we look at the numbers. Do you want to make a comment on this, Joyce?
Yeah. Do you want to guess like which one's the most tax effective? Which scenario? And I guess, the question is, should it be pulled out? Like scenario one, should you do scenario one, pull it out now before 30 June?
But this is a good test because it's a gut feel. What's your gut feel? Where do you guys and ladies think you would? Feel free to sort of post it in the chat box. What if we give people just a couple of 20 seconds or something just to think about this one?
Yep. Someone says scenario 3 is the most tax effective. Yep. Someone said, yep, super will still be better. What's scenario 1A again? So asset is bought.
Well, let's say it's outside.
Oh, outside.
So one is you're buying it out, but you're on the top rate.
Understand. Yep. Gut feel is it's better in super and yeah, of course, scenario 3 is the best.
Okay. Won't hold you in suspense. We'll move on. As I said, I've got this guest at the end, the surprise guest. So I want to keep them anxious about this surprise guest. It's really worth hanging around for. So here are the results. Those that guessed scenario 3 are right. Your average tax inside outside would be 16%, whereas scenario 1 is 31%. Now, we did detailed spreadsheets on that. There is an article on our website going through a little bit more detail than that. That's also linked on that prior slide. So here's a colleague of mine, Bryce Fago. Bryce, some of you may know, he's well known in the SMSF space. He's got far better jokes than myself. He's got the best SMSF jokes in the world.
We've got to bring him on soon on Tax Nuggets for sure.
But he's probably not as good as the surprise guest at the end of this session.
There's a lot of hype, Daniel.
Anyway, Bobby wants to withdraw 7 mil from his fund during 2026, this financial year. He's got 10 mil. He's heard about this Div 296. He's not very happy. He's going to end up with a 3.5 mil at the end, so he's going to probably cop a bit of this tax. He wants to withdraw a 5 mil commercial property in Victoria and 2 mil in cash. His cost base is 1.65, so he's got about, after the 1/3 discount, he's got a 2.2 million capital gain. He owns other Victorian taxable land, so it's not his PPR, it's not his primary residence, not exempt from land tax. So land tax is a real concern, as I mentioned before. The $7 million returns about $150,000 per annum, so it's not highly, income orientated. It's more capital appreciation, particularly because of the property that Bobby has in his fund. And Bobby doesn't have much income. He's got $35,000 outside of super. He is also in pension mode. So there's a few facts we're throwing at you there, but broadly, he wants to rip out $7 million, and we're just going to go through, well, what are some of the considerations here?
And is it because of Div 296 or maybe other commercial reasons?
Look, a lot of people come to us because they've been really perturbed, and this advisors and accountants and other advisors will find this, that a lot of people say, I don't want to pay this tax, I don't want to pay this tax, I'm out of here. I'm going to rip it all out of super. That's often the first impression. And what our job as advisors is to say, hey, clients, slow down. You might be doing yourself a disservice. That's what this is all about. We've got to give you advice because you may be better off. You don't want to shoot yourself in the foot, client. Let's do some number crunching. And that's what I'm giving this is what this is all about today. I'm trying to teach people on how to analyze this tax, like tax inside, tax outside. And what if we rip it out? What are some of the other consequences of ripping out assets like real estate? So everything has a cost. And some further facts are, should we withdraw it on 1 July 25 or 30 June 26? And he's in pension mode. So Bobby's pension exemption is looking broadly much better if he rips it out on 1 July 25 because he's mainly in pension mode, but not as attractive on 30 June 26. So there's a $2.2 million capital gain. He's got land tax issues. He's got other issues to consider. What do you think is the best time to withdraw it? And we're on to a poll.
Oh, yeah. Get involved, people. Scan the QR code or the link is in the chat for you to join. Only 2 options, so you got a 50-50 chance. What is the best time to withdraw? 1 July 25 or wait till the end of the year? Oh, very conflicting answers. Thanks for voting, people. I will click to see the answers.
So most of you are going 1 July 25. Well, that's pretty good, actually. 2/3, 2/3. I love this. It changes a bit.
Is that the right answer? Is it the best outcome?
A is the best outcome. So those have got A. I wasn't trying to give any direction one way or the other there. I was trying to stay neutral, but those that win A are correct. So let's move on. This is how we analyse this. Factor 1, land tax. So we're looking at Victoria. You'd have to do your own analysis interstate, but remember there's a $5 million property. Bobby already has property in his own name. He's already sort of complaining about land tax personally. In Victoria, we pay land tax as of 31 December every year. Mm-hmm. So from a land tax perspective, it's better that he withdraws it after December this year. So that gives Bobby a bit of a saving of about $38,000. So Bobby's $38,000 better off on land tax to defer it after December. Then we look at tax payable inside and outside. Recall, Bobby's got a low taxable income prior to the 7 mil, and the self-managed super fund tax is assuming a 1 July transfer. There's no tax because he's pulled all the money out, basically, a lot of it. But assuming the super fund transfers out on 30th June, after taking into account the 29% pension exemption, we're looking at about $16,000 of tax. So we'll assume there's no other income on the other assets apart from the 7 mil. Bobby's position is Bobby will assume there's no senior Australian pensioner tax offset. So the SAPTO is a different position. I haven't really included that in the slides. I just wanted to sort of take it a little bit more simply. But if Bobby transfers it out on 1 July, he's paying about $53,500 in tax. But if he withdraws on 30 June 26, he's paying about $3,500 in tax. So the overall position is it's $54,000 versus $16,000 in the super fund. So it's best that the 7 million transfer occurs on 30 June 26, and there's a $37,500 saving. So far we've got land tax favouring this. We've also got tax inside outside favouring a deferral because the super fund's paying far less than Bobby.
Mm-hmm.
However,
but that's not the end of it.
It's not the end of it. It's in fact, we're only taking into account 3 factors, but CGT, remember, there's 2.2 mil. Even after the pension exemption, as mentioned, the pension exemption in July is 96% compared to 30 June 26, which is 29%. So that's why this pension exemption, the CGT, this is the most sizable impact. This has an impact of it's $224,000 impact. So the CGT impact was a big impact, and that favours 30 June 26 transfer. Sorry, it favours a 1 July 25 transfer.
Yep.
Yeah, so sorry, I didn't. You don't want to You don't want to mess that one up.
Yeah, yeah. Can you just remind us what the pension exemption and how it works really quickly?
Okay. Look, you've got a maximum transfer balance cap of 2 million today. All you can put into a pension today is 2 mil. In Bobby's case, he had 10 mil, so his maximum in pension would be about 2 mil. And as a proportion of the fund, it came out to 29%. 2 mil after over 10 mil. Those numbers may have been a bit different when he started the pension. Would have created a 29% exempt proportion. So 29% of the earnings is effectively tax-free.
Mm-hmm. Mm-hmm. Geez, yep, that's a huge difference.
Now, summing this all up, you can see there the difference is 30 June 26, he's better off by 150. No, 1 July 25, he's better off by $152,000.
Yep.
So they're not all the factors. There's more factors than that we would need to consider, but that's just to simplify it. But, CGT was the big hit, so focus on the big hits. But that case study was all about, have you thought about everything in your modelling? Have you factored everything in? Land tax, capital gains tax inside, capital gains tax outside, etc., tax rates. So there's a lot of thinking that is required in modelling for your clients. To do this properly will cost some money. Look, naturally there are those with a gut instinct. And let's say you've got a client who's going to get slightly over 3 mil. They might say, I'm just going to rip some out. Well, you might take that a bit easier. But always remember as well, can you give financial product advice? Because when we're talking about contributing or pulling money out of super, we're talking about a financial product where you need to be licensed. So always issue your disclaimer. Make sure you're sticking to what you can legitimately and legally give advice on.
Yep. So I can understand this advice is more about when it should be pulled out, but was there a different advice on should it be pulled out anyway at all?
Well, that
kind of thing.
That was in our prior example. Our prior example was we were better off overall in pension, but you've got to do your modelling on each scenario. There's not like it's always this way or it's always that way. You've really got to get to the specifics of your clients, run the numbers, do some modelling, and then after a while of doing that, you'll get a good gut feel of one way or the other. As I said, I'm not really going to talk about SAPTO, but it is there for your reference.
Yep. So hopefully that answers your question, Kirsty, about, are you advising in general whether clients should be building wealth in super? Really a case-by-case basis. Yeah, Daniel?
It is, but moving forward, I think people will be far more conditioned to say we don't want to get more than 3 mil. But unless that's indexed, as we said, we're going to have 8.1 million people, just over 2050, getting hit up with this new tax. If they do not index. And Chalmers are saying we're not going to index.
Gordon?
So look, so far as well, we haven't got into advanced planning, like we haven't got into using family trusts, we haven't got into companies, haven't got into Div 7A loan agreements. So we can then explore opportunities with our clients who don't like super to say, okay, if you're going to rip the money out, where do you park it outside of super? It's probably not best in your name. It's probably best in a structure like a family trust. Now, one of the big unknowns with this government is this. The tax institutes raised, if they succeed with introducing this very unfair tax on unrealised gains, what will be next? Will it be the family trust? Will it be your business? Will it be the farm? Will it be your family home? Your share portfolio? What will be next? Because they get away with super, nothing's out of range here. Consider things like negative gearing, succession planning. That here's a happy little family. This is my take of a happy little family. You can see mum and dad, you can see the kids. They're all happy. They got the right structure in place, maybe. But this is where we're getting outside of super. Outside of super, the family trust is a popular vehicle. It's popular. It's still flexible. Again, we're talking about the law today. Hopefully an unrealised gains tax doesn't come in for a family trust, but it has been on the cards earlier on. So the family trust could distribute to mum and dad, to the kids. There's not much in the kids under 18, but when they turn 18, there's distributions. We've then got to manage the reimbursement agreements under Section 100A of the ITAA 1936. We can distribute to a company. If we distribute to a company, we've capped our tax rate at 30%. If the company's got too much money, we could do a Div 7A loan to, say, mum or dad. We've got to make the minimum yearly repayments. But this is what's going to happen. With the $3 million cap, I remember years ago, we used to have clients, our regular client had not only a self-managed fund, they had a family trust in the company. So as advisors, you might say, we've got a lot more work coming our way, a lot more complexity, and now we can be a lot more sophisticated in front of our clients. They can't just go to the average tax return preparer. They've got to come to us because they need advice and assistance on managing all these other problems in the family trust. Section 99B, 100A, reimbursement agreements, UPEs, unpaid present entitlements, the company, Division 7A, dividends. Have we made our dividend resolutions? Have we made our trust resolutions? Do we need a family trust election? Does the company need an interposed entity election, et cetera, et cetera? So this is where things might go. And I've just outlined, with family trust, they're still flexible. However, future reform, your guess is as good as mine. Basically, can we trust the government? Not really. Tax is they're always saying we need more tax. No, if they're going to spend $380 billion on submarines, well, if they're going to spend more than $50 billion on NDIS, you can see why they need more and more tax. So I'm not going to really go into family trusts of how they are taxed, but it is there for you. There's a couple of points. We can use a corporate beneficiary. We can income split. You need to do your resolutions before 30th June. We can get the 50% discount through a family trust if we stream the capital gain. Even if you don't stream it, potentially there's a 50% discount. Be very careful about family trust elections. The ATO is really cracking down on family trust elections and interposed entity elections. So be very careful you're managing those.
Yep. It's a real opportunity, when a client comes to you and says, I don't like super anymore, what are my other options? It's a big tax planning opportunity, right? Yeah. And we have to consider family trusts and other structures.
And I've just thrown some numbers here. I've said, look, let's assume on the right-hand side, you've got $1 million outside of super, you're earning 5%. It's $50,000 a year. Like in a family trust, you can split. So in Section A on the left-hand side, the total tax liability is coming out at $194,000, but we introduce 2 adult children. Our tax liability has reduced to $150,000. So we've saved about $44,000 in tax by having a family trust for income distribution purposes. So we've got our average rate down from 35% to 27%.
Yep.
Just a point on disability insurance, another poll which is coming up in a moment. Steve has $3 million in super. He's feeling fit and well. He's at 50. He suffers a stroke. He gets insurance for TPD, total and permanent disability, of $2 million. He needs some money to adjust his life, so he wants to get his house in order and a few other things in order. He pulls out that $2 million by 31 May.
Mm-hmm.
He still has $3.2 million in super as of 30th of June 26, including $200,000 of net earnings and growth. So how much tax do you think Steve would pay? So if we could get that poll up.
Mm-hmm.
Let's let our attendees think this one through. What's your gut feel?
It's a big difference, isn't it? So scan the QR code, people. First option is about 140,000 due to 96 tax versus like $2,000. Well, my gut feel without doing any calcs is surely it can't be more than $2,000.
Well, Joyce, it'd be a bit sad, wouldn't it? You've just suffered TPD and the government comes along and says, we want to slug you on your 2 mil.
And didn't the, super balance only go up by 200,000? So like from 3 to 3.2. And so, yeah, like that gut feeling, it should just be like $2,000, div 296 tax. Anyway, don't keep us in suspense. What's the answer, Dan?
Well, let's look at our audience first. Majority is at $2,000. The majority is right, but you can see the others thinking, "Oh, we don't trust this government. They'll hit us. They'll hit us up, even though we're TPD." No, it is the first one. It's just below $2,000. So let's move on. Here's where the proof is. It is interesting because not all insurance gets this carve out, but disability insurance does.
Okay.
Structured settlement is another one where you're seriously injured and you have you get a compensation or court order and you are seriously injured. You can put money in even if it's 10 mil. I know if people have got very big compensation payouts and they've been paralysed for life or whatever, they've got 6 mil, they've put that in super and that won't get the Div 296 tax forever if it's a structured settlement. However, in this case, we look at the law and in this case, what we're going to have, because it's TPD, it's treated as a contribution and deducted from his adjusted TSB. There's the legislative references. But in this case, have a look at the third bullet point. We start off with 3.2. We take off the 2 mil under 296.55(1)(e). We then add back the 2 mil because that's a withdrawal. Remember, withdrawals are added back. So the first instance is the 2 mil is taken off because of specific TPD carve out, but then he's made a withdrawal of 2 mil, so it's added back on. So we end up with 3.2 mil.
Yep. Quick question here from the audience. Does contribution splitting with your spouse, is that considered an add back?
It is an add back and it was on my earlier slide.
Yep. Great.
So refer to that earlier slide on the pluses and the minuses. So there's the legislative references for answering that question for your future reference. I know we're covering a lot today, but these slides are very good notes. You can take them away, use them, refer to them, read them.
Yep. We've got about 5 more minutes left.
Yeah, well, we're doing pretty well.
What's the pointy end?
Yeah, and I just might make a call out. We do regular news feeds, so if you do want to subscribe to our news feeds, do so from our website, and you'll get a regular monthly free news feed on SMSF and tax-related matters. So the important point on this slide is, look, we have quite a number of people. We do all the analysis, and let's say after doing the analysis, we've worked out they're better off in super. The real important thing here is that they've got their succession planning done so that if, for instance, particularly if there's only a surviving spouse, that if they're getting a bit shaky or they might pass away soon, we can get the money out of super quite quickly. Otherwise, we're paying the death tax when it goes to the adult children, or if there's no tax dependent, such as a spouse or minor child who survives. So here's an example. Here are candidates. Mum and dad have 1.9 each. But let's say mum dies first. If mum dies first, dad's got 3.8. So dad's going to get hit up with this new tax. So it is sort of a death tax. So one of the points that we're making is that reversionary pensions are not necessarily the best thing. A lot of people say, reversionary pension, it's got all these benefits. Well, we say, hey, there's pros and cons about reverting, but here's the instance where someone well under 3 mil will get hit up with this new tax. So indirectly, it is a sort of death tax. So do you need to revert your pensions? Because if you revert your pensions, you could have this situation. But what we actually say is that, here's the comment here in green, you never know the hour nor the minute. It strikes like a thief in the night. Now, that's a biblical takeout. So that's in the Bible. I'm not exactly sure who said that, but someone who's more religious might have the exact reference. I'm sure you could Google that. But what we say is, look, you should have all the documents there. You should have all the documents ready, the will with the testamentary trust, the enduring power of attorney, the BDBN, the trust succession, successor director nominations, appropriate deeds, and more. This is where clients really need to be covered, because if you say you're better off in super, and if your clients continue in super and then they get hit with the death tax, well, they may be worse off.
Mm-hmm. Is this like the angel of death strategy thing?
It is similar. It's got similar instances.
Yeah. I've heard of this so-called
Yes.
in the deathbed, then you quickly make a change before it happens, kind of thing. Yep.
Yeah. So look, just to wind up, if people are within Div 296, they should generally withdraw their money to pay the tax from the highest taxable component. As mentioned, people may wish to change their reversionary pensions to make them non-reversionary. Obtain quality valuation reports. Everyone's going to want the highest value come 30 June. Auditors will be on the lookout. Is that sus? Will that survive scrutiny? We would be suggesting you prepare interim accounts for people each 30th June. Sit down them. Do they want to get hit up next year with this Div 296 tax? Do they want to withdraw? What's their strategy? So once you get all this modelling done, it could be used year after year to have another session with them to say, hey, we want to talk to you about Div 296. And as I said, if you're giving tax advice, if you're giving factual information and accounting information, it is not financial product advice, but be very careful because it's very close to the edge where they may allege it's financial product advice. And what happens, for instance, you said to pull it out, they pull it out, and then they realise they could have been better off staying in. And then they come back and sue you and say, you gave financial product advice, you weren't licensed, we want blood. Not a good outcome.
Yep.
Okay.
I just want to answer a couple of questions.
So it won't take long, but it's worthwhile hanging around for.
We just have got, I'll just try to get through at least a couple of questions. If withdrawals throughout the year are added back for the TSB at 30 June, isn't it already too late to take the money out?
The threshold under 296.35 is you have to be over 3 mil at the end of the year. And secondly, you have to have taxable super earnings. So provided you've pulled yourself below 3 mil, you will not get to the initial threshold, let alone the second threshold.
Sounds good. And I think, there's just still a bit of confusion about, that Bobby's scenario and the pension exemption. How did it get from 96% on 1 July to 29% on 30 June?
That is a good question. So when you go to the actuarial analysis, and we have done the detailed spreadsheeting behind this, if you pull out 7 mil on 1 July 25, you're left with mostly money in the pension. You've only then got a very small accumulation balance. But if we continue on throughout the year until 30 June 26, we've only got a maximum of 1.9 to 2 mil in pension, and the rest of the $8 million odd in accumulation. So you can see that alone gives the answer.
Okay. And final question, if you transfer or split up with your spouse, I guess, in 2026, and still under 3 million, but then in 2027 you are over, do you still have to add it back in 2027?
The only comment about that, is this a family law split we're talking about, or is it a super split from a contribution split?
Not sure, actually.
Let's say it's a family law split, because I did cover this before. Let's say dad is giving up 50% of his super to mum. That is added back, but it's added back in the year that dad gives that up. And mum receiving it, it's seen as a contribution. So she deducts it from her adjusted TSB.
Okay. Mhm. Hopefully that answers your question, Andrea. Yep, she says, thank you. Yeah, we just launched a couple of polls. Let us know what you thought of today's session. Always welcome feedback. And also let us know where you first heard about us. Would really appreciate the answer to that, marketing intel and all that. Amazing. I think that is all the time we have left for Q&A. Yeah, everybody put your emoji hands one last time to say thanks very much to Daniel Butler. Hope to see you next time soon. Cheers. Bye, everyone.
Bye.